Commercial real estate loan sizing is one of the most important concepts you need to understand when you're involved in this industry, whether you're working as an analyst for a bigger company or you're an individual investor trying to capitalize your own deals. And while residential loan sizing is pretty straightforward based on a borrower's income and the value of a property itself, commercial real estate loan sizing has a lot more moving pieces to take into account. So to break this down in more detail, in this video, we'll walk through the 4 main loan constraints that commercial real estate lenders use, why each of these matters, and how all of these work together to help real estate lenders calculate the total loan proceeds they're willing to issue on a deal. So throughout this video, I'll be referring to loan constraints, and what I'm really talking about here are the metrics that commercial real estate lenders use to come up with a maximum loan amount on a deal they're considering funding. And to start off with arguably the simplest constraint of all 4 of these metrics, we have the loan to value ratio, or LTV. The LTV measures the loan amount as a percentage of the total value of a property, with value typically being determined by a third-party appraiser, and lenders will set a maximum LTV percentage to size a given loan. For example, if a lender has a maximum LTV constraint of 65% and a property is valued at $10 million, those loan proceeds would max out at $6.5 million, regardless of the interest rate or the income that property generates. This metric is primarily intended to help lenders protect the value of their collateral or the real property that's securing the loan, specifically in the case that they had to foreclose on an asset and then sell that asset to another third party. Most lenders will have a maximum LTV ratio somewhere between about 60 and 75%, but this can vary a lot based on the business plan, the property type, and the type of loan product the borrower is ultimately looking for. Now, next up from here, we have another relatively straightforward loan constraint, and this is the loan to cost, or LTC ratio. The LTC measures the total loan amount as a percentage of the total cost of the project, so not just the value of the property at the time the loan proceeds are issued, but also any closing costs, upfront leasing costs, or any planned renovations that will increase the investor's basis. This means that if we were to buy that same $10 million property, but we plan to put $1 million of additional capital into it, and our closing costs were projected to be another $100,000, our total cost would be $11.1 million, and with a 65% loan to cost constraint, our maximum loan amount in this scenario would jump up to a little over $7.2 million. And similar to the LTV ratio, maximum LTC values will typically come in anywhere from between about 65 and 75% of total project costs, and the LTC ratio is usually relied on most when the value of the property at the time of acquisition is not necessarily indicative of what the value is projected to be once the property is stabilized, which is very often the case on ground-up development projects and major value-add deals. Now, the next loan sizing constraint I want to cover here is directly dependent on the income generated by a property, and this is the debt yield. The debt yield measures a property's net operating income on an annual basis as a percentage of the total loan amount, meaning that if a property were to generate $600,000 of net operating income and the loan amount was $6 million, the debt yield in this scenario would be 10%. Minimum debt yields today are typically coming in anywhere from between about 8 and 12%, again depending on the business plan, the property type, and the type of loan product the borrower is looking for, but in general, lenders are looking for reasonable assurance that they'll be able to maintain their yield even in a foreclosure scenario. Just like equity investors, lenders make investments in commercial property to generate a return on those investments in the form of interest they charge to the borrower, but if that borrower defaults and can't pay those interest payments, the lender may have to foreclose and take ownership of the property. And in these types of scenarios, the lender would still want to make sure to at least be able to generate that original interest on the loan, which is why we've seen these debt yield requirements tick up over the last few years as interest rates have also increased. Now, finally, we have one more loan constraint that's also dependent on the NOI a property can generate, and this is the debt service coverage ratio, or DSCR. The DSCR is calculated by dividing the property's annual NOI by the annual debt service owed to the lender, and this essentially measures how many times over a property's income can cover required loan payments. Minimum DSCR requirements for lenders usually fall between about 1.2x and 1.5x, again depending on the business plan, the property type, and the type of loan product, but this is one of the most heavily relied upon metrics for lenders sizing loans on existing existing commercial assets. And the way lenders will use this metric is again by back solving for a loan amount using that DSCR requirement along with the interest rate and the amortization period that will also affect monthly payments. For example, if a lender had a 1.35x DSCR constraint using a $600,000 NOI, we could calculate the maximum loan amount by first calculating the maximum annual debt service that can be supported by the property by dividing 600,000 by 1.35, which equals just over $444,000. And from there, we can use Excel's built-in PV function to calculate the loan amount. And if we assumed a 6% interest rate and a 30-year amortization period, we could use our interest rate on a monthly basis as our rate, our amortization period on a monthly basis as our number of periods, our maximum debt service on a monthly basis as our payment, and 0 as our future value to get $6.18 million in total loan proceeds based on all of these factors. Now, the way a lender will ultimately use each of these loan amounts together is that they'll take the minimum total figure among all of these constraints. So in this scenario, with a maximum loan amount of $6.5 million based on our LTV constraint, $7.2 million based on our LTC constraint, $6 million based on our debt yield constraint, and $6.18 million based on our DSCR constraint, our maximum loan amount on this deal would be $6 million in this case, even though the DSCR, LTV, and LTC constraints could actually support higher loan amounts. Ultimately, these are the 4 biggest metrics that lenders will look at when deciding on the total loan proceeds they're willing to issue. And if you want to learn more about other loan terms you'd be expected to know as a real estate analyst, or you want to know how all of these calculations work together within a larger real estate pro forma, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on commercial real estate loans, make sure to hit the like button and let me know. And let me know in the comments any other loan terms or types of loans you'd like to see covered in more detail on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.